All right, guys, this is high volatility strategies. Number 4 is the short put spread. And this is high volatility strategies. This is 4 in several of these high volatility strategies. One thing to note with these high volatility strategies, or any of my webinars, actually, let me get this out of the way, is watch this again. And I have other short put spread webinars out there. You can watch that one again also. Like I encourage you to watch this one again, because the second time through, it's going to really make some of these nuances really stick in your long-term memory. You'll be able to remember it longer. You know, if you are more accustomed, or you're more of a trader that's been familiar with some options trading, watch one of my other ones on the short put spread. I try and make all of them a little bit different because in 1 hour, it's really hard to go over everything in and around a short put spread. So with it being the high volatility strategies, I'm going to lean more towards talking a lot more about volatility in and around this strategy than I would in maybe one of the other webinars. Okay. So whatever you do, but watch another short put spread webinar that I've done so that you get the full gamut of what I'm talking about. And again, sometimes I forget to talk about it. Like in the short call spread, I remembered a couple of things I wanted to talk about that I'll cover with the short put spread because they're very closely related. All right. Anyway, let me get a couple of things out of the way real quick. My name's Eric Wilkinson. Some of you guys may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. I started out trading in college with some money I had earned, and then after graduating, I moved straight to Chicago and basically cashed out all my stocks that I had been trading. And in that time, I've traded everything, like I said, stocks, financial futures, commodity futures, currencies, and options on all these markets in just about all market conditions. You also probably have all seen this before. It's a disclaimer. At the end of the day, we're here to teach you guys how to trade. I'm not that guy that is going to give you a trade recommendation because, for one, I don't know your risk parameters. I don't know what's in your portfolio. And two, I don't know if it's appropriate for you. Okay. You might have, say, long Tesla in your portfolio and I'm bearish Tesla. So don't necessarily do everything that I do. My market assumption might be completely different than you or wrong compared to what yours is. So, but all of these things that I'm going to teach you, you can take those basics through my essentials to success and implement this strategy around another underlying or an underlying you're interested in. And at the end of the day, do your own homework. Past performance of any trading system or methodology is not necessarily indicative of future results. All right, this is my Twitter handle. It's Wolfman's blog, and our parent company is Pro Trader Strat. Right now being earnings season, if you guys watch my Twitter feed, you know I throw out at least I try to get out all of them, my earnings trades, because in the daily market commentaries in the morning when I talk about the economic numbers and what the markets I believe are going to do and all of my trades getting in and getting out, whether it's a profit or a loss, I do those in the daily market commentaries. But at the end of the day is when I enter my earnings trades. So just so you guys can follow along, I throw that out there on Twitter. I don't give the exact strike because all those people on Twitter aren't necessarily following my daily market commentaries or have learned what my rules are. So if you've learned the rules, you'll know immediately what strike location I'm looking for any earnings trade. All right. Like I mentioned, this is the short put spread. We need to have a bullish assumption. So selling puts is bullish, all right? When you buy puts, it's bearish. But when we sell puts, we're bullish. It's also known as a bull credit spread or just a credit put spread. But you can get away with this in a market neutral environment. If you have high implied volatility, you expect this market to go up. You will not be hurt if it just trades sideways, all right? You won't make your money as fast as if you were directionally right, but you won't get hurt if it's trading sideways. You can even make money with this strategy if the market starts going directionally against you, as long as it doesn't go too far, right? That's the beauty and the put spread is when you're selling options, you can be directionally wrong and make money. When you're buying those options, you need to be pretty darn right away. Okay. So that's the beauty in selling options. All right. One thing to know with this also is you're always going to receive a premium. Anytime you sell options for a credit, that is going to give you a premium. You're going to collect money. You get to keep that. All right. And we are going to be exploiting theta decay and volatility contraction. That's really what we want to take advantage of. And volatility contraction, believe it or not, will help you out faster than even theta decay on any given day. 1% of volatility comes out of this when we're in a high implied volatility market, that will help you faster than one day going by with the theta decay. All right. Essentials to success. Picking the right environment. I've mentioned this several times. When we are selling premium, we need high implied volatility. And there's a lot of reasons for that. High implied volatility gives us more premium, gives us more bang for our buck. It also allows us to get further away from the underlying and collect that same credit. So if it's really low implied volatility, and I'm looking at the 100, the stock trading at 100, I might have to sell in a low implied volatility market the 95 puts. But when it's a really high implied volatility market, I might be able to go all the way down to the 85 puts. Okay. So here's a couple of examples, and they're not perfect. All right. But what I tried to say, John, I see your question. I'll get to it near just a second. I might even answer it here in a second. What I want you guys to take away from this, this is FXE, and there aren't stock to stock. This is an ETF, and ETFs usually have a lower implied volatility. All right. But what we're looking at here is FXE has a really low implied volatility percent. You can see it's at 8%. Now, if we look at this underlying, it's trading at 108.42. So we look at the 108 strike. That's the at the money, right? We can all agree on that. Let's just go out to this 110 calls, or we could even, let's say 108. Let's go down to the 105 strike here. So the 105 strike, you can see it's zero bid at 28. And if we went up further to the 110 calls, all I'm trying to do is give you an idea as to how volatility is going to affect this underlying. So if I'm looking at calls or puts, it has nothing to do right now with setting up this strategy, but to understand volatility a little bit better. So if we go out to this 110 strike on a $108 stock, $108.50 stock, go out to the 110 strike, 8 days to expiration, 5 cents. We go out to the 36 days to expiration. Look at that same 110 strike. It's 31 cents at 35. Okay. Now, let's look at another stock. It's $109.72. So it is $1 higher. Okay. I couldn't get a 108.42 and a 108.42 at the same time, believe it or not. But look at this. We go and see that the implied volatility percent is at 69.63. Now, Twilio might have just a higher implied volatility than FXE, but you get the idea. Higher volatility. And we look at this 110 strike with 8 days to expiration, and look how expensive these are. It's still a $109 stock, or even if it's $1 higher, we would not see that kind of difference on this premium at the 110 strike, because $1 higher, we know that if the underlying increases by $1, these premiums increase by the delta. So the 110 strike is going to increase only by 7 cents. So that's still nowhere close to where we were looking at with the Twilio, where, the 110 strike is $8. Okay. Massive difference, right? Go down here to the 110 strike. That's, we could say that's $10, just being middle of the market, and come out here 35 cents, $1 higher. We add in the 26 cents to this, right? Because delta, for every dollar move higher, you add the delta into the premium, right? Same over here, $1 lower, you add the delta into the premium. Okay. So we can see that even with that $1 higher, to make it the same price at 109.42, come very close to the other one, we can see that this is only going to be trading around 50 or 60 cents, right? So massive difference. All of a sudden, I want an olive martini, LOL. I know, JQ, I'm ready to lose this, 2 of my screens, and I think it has to do with my video card. Hopefully the video card does not crash during this webinar. All right, so John's asking, did you say that 1% volatility increase or decrease has a greater impact than theta decay? Yes, it does, and we can see it right here. So theta for this, 2 cents a day comes out of this premium, right? But if this adjusts by 1 percentage point, goes from 5.84 to 6.84, this is going to increase by 7 cents. All right. And vice versa. If this decreases to 4.84, this is going to decrease by the volatility, which is 7 cents. But you can see the Vega number is bigger than the theta number. Does that answer your question, David? So volatility affects premiums more than theta, and you can see that just about anywhere. And if we look at this is the one with the higher implied volatility. Theta and Vega on this one are pretty close, and closer to the at the money. That's a little bit of an anomaly, right? Or not an anomaly, I should say, John. But you know, the closer you get to theta, yes, that rule doesn't necessarily apply. This $1 would affect that more. But what I'm talking about is in the options contracts that we are going to be playing around with this strategy. That's what I'm talking about with that volatility coefficient, likely pricing in a bigger price fluctuation. It's not completely consistent, John. You're right. You got me on that. The closer to the expiration, this theta is going to jack up. But for the most part, this volatility coming out and 1% volatility decrease on a daily basis is not that much. You can see even today, basically it went from 26 to 25. So it got its 1% coming out within that one day. Yeah, 1% versus 1 day. And I'm talking about in the options that we are going to be dealing with. Yes, closer to the expiration, theta starts increasing. And I'll even talk about that more here in a minute, about the theta increasing. And then picking the right underlying. What we're looking at for this one, for picking the right underlying, you know, there's all kinds of stocks out here that, you know, we could look at on a daily basis. But my rule for this is when we're looking at something for like, say, GDX, what we want to do is go to the options. Now, these are not the spot month. We want to go to the spot month, and it's the one with the most volume and open interest. And you'll see that people are slowly moving out of the out of GDX in the fronts and starting to put more and more volume back here in this spot month. So this is really the month that we want to be looking at. It has really the most participation for this rule. So picking the right underlying, we, you know, for instance, we want to say, I want to trade some GDX. I'm maybe bullish in GDX. What I need to do is see if the option montage has tight markets. Okay. And my rule of thumb for under $100 stock is the bid to the offer should be less than 10 cents or 10 cents or less. Okay. On the bid to offer, you can see this fits that rule. And if it's over $100 stock, we would move this decimal place 3 ticks to the left, and 17 cents is how wide the bid to the offer should be. And this does usually fit that rule. It's pretty close. After the market, it gets a little bit wider, but just double check it during the day session when there's participation going on. Make sure it fits that rule. Over $100, move the decimal 3 ticks to the left. That's how wide these markets should be on the spot month. You know, about 35 days to expiration is where everybody's playing. And make sure it follows that rule. Nvidia, 3 ticks to the left, it would be about 15 cents wide is what we're looking for. And Nvidia usually fits that rule as well. Okay, does that make sense? Alta probably doesn't. I like to trade Alta during earnings, but 3 ticks to the left, 30 cents. That wouldn't fit this rule. So it would be a yellow light, okay? So green light is it fits my rule. Yellow light, it falls just outside of that. And you could say it's a yellow light, you know, to a point where, you know, this is pretty close, 50 cents, a double on that. I would say if it goes to a double, that would start becoming a red light. So if it was 60 cents wide during the day session, I would say this is a red light on that. Okay. But inside that would maybe be a yellow light. All right. Picking the right duration. Picking the right duration. I talked about this with that theta decay a little bit, you know, so theta decay down here, John, you know, obviously this theta decay is going to supersede volatility contraction number. Okay. Because this is where it really ramps up. What I'm talking about is out here when we're playing, at around 35 days to expiration, 35 to 45 days to expiration is kind of where I look for this. Closest to, you could even say, you know, so if, you know, there was like an option that was 25 days to expiration, the other one's probably going to be about 40 some days to expiration. I'd probably pick the one that's 40 some days to expiration. So I get this volatility contraction in my premiums. You can see further out in time that volatility really slows down, but we want to take advantage of this 50% drop in our premiums just through theta decay. And we get that volatility contraction on top of that. You will be very happy. How do we define the spot month? The spot month, we used to just say the spot month was the one that really carried the most volume and open interest, but really the spot month is going to be the one that is closest to 35 days to expiration. That's usually what is considered the spot month. People are starting to roll into this. They want to be in this for that 35 days to expiration because they want this theta decay. All right. All right. Now picking the right strikes, super important, guys, because, you know, when we're selling just a naked stock, we know the strike location we're going to go with this. This one, we know the strike location we're going to shoot for is a 36 delta. Now, remember when we were talking about the just short calls, we were talking about the one standard deviation, right? That's the 16 delta out here. The thing with the short put spread is we are going to have to go to about the half standard deviation, which is the 36 delta. And that also adds up all of these numbers here. You'll get 36. Okay. And add up all of these, you're basically going to get 84 or very close to it. It might be 34 or something. But at the end of the day, we want to shoot for this half standard deviation strike, which is right around the 36 delta. And that is where we're going to start building this out. Now, another rule with this, picking the right strikes, is we need to make sure that we are looking for collecting enough credit for the width of the spreads, okay? Because we need to make sure that our reward is in line with our risk. And what my rule for this is, you need to at least collect 33% the width of the spread, okay? And so on a dollar wide, we're collecting 33 cents, right? On a $5 wide, we're collecting about $1.65, okay? So on a $10 wide, we're looking to collect $3.30, right? So that means our probability of success is about 66%, because what we do is we take the risk, which is our 66 cents out of the dollar wide, all right, and divide that by 100, you get 66%. All right, so we got a 66% probability of success. Now remember, the naked strategies, we had about an 84% probability of success. We had more risk to the upside or the downside, but we had less risk in the eyes of my eyes, because we had about a half of the probabilities of being in the money. All right. Can you clarify the standard deviation again? Yes, absolutely. So picking the right strike is very important, because this is a half standard deviation right here. This is a half standard deviation. Now, what standard deviations do is tell us the bell curve, right? So if we looked at this, you know, as the right now, it's basically 50% that way and 50% that way, right? Well, 19.1%, you subtract that out of this, and you're basically going to come up with about 36%, really. I don't why is my math not coming out right? 36% would be about 45. But if we added up 15 plus 9, that gives us 26, plus 4, that gives us 30, 31, 32. It's like right around 33, kind of 33, 34. But we're going to be looking at the 36 delta. All right. So right around here, 36 delta is very close to the half standard deviation move. That's why. And we should try to get at least 33%, David, or John, 33% the width of the strike. So 33 cents on a dollar wide. Okay. Now, you guys, volatility, yes, 33. So volatility does a lot of things to this. This would be this bell curve right here. If I can find my cursor, this bell curve would be like normal volatility, okay? Middle of the road. If volatility comes out, what happens is this standard deviation curve starts jacking up and gets really narrow like this, okay? So that would be very low volatility, okay? No skew. But you can see the standard deviation move. Now my one standard deviation or half standard deviation move is very close to where the underlying is trading, right? So we don't want that. We want volatility. What it is kind of like a big bucket. Think of it like this. And you fill up this bucket, the higher volatility goes, the more this bucket fills up. So this would be like almost nothing in the bucket, okay? Now you come over here, you get high volatility, and what happens is this volatility kind of squishes out. So now our middles right here, our half standard deviation might be here, and then our one standard deviation way out here, okay? And what happens is because that bucket got filled up with volatility, and now it's like this. It's kind of squishing it down, right? Puts downward pressure on the curve, right? I don't know if that's a very good example to get you guys to picture what volatility does, but this is volatility, and it pushes down on the curve, and it spreads the probabilities out further, okay? Because volatility says, hey, this has some wild moves going on. It could make it out there now. But my premise is that volatility is overstated, okay? Fear is overstated. Volatility is a very good judgment of fear in the markets, all right? Whether it's fear to the upside or fear to the downside. It's from people buying options for protection. And when they buy options for protection, they pump up that premium. And when they pump up that premium, volatility goes up, okay? So as volatility goes up, it squishes this down. Now, Gene's asking, why the 36 delta for the short put? Because it allows my rules to come in, right? So we need to collect at least 33% the width of the spread. That's going to usually line up around that 36 delta. That 36 delta is about a half a standard deviation move. 36 delta also is, with this spread, gives me a 66% probability of being right, which is better than just buying stock. If you go out and buy a stock on any given day, your probabilities of it going up when you bought it or it going down when you sold it is 50-50. Every single day, it's 50-50, whether it's going to go up or it's going to go down. I don't care if it's up against a Fibonacci or anything. It's still going to be 50-50. Now, with our option strategy, we're getting a 66% probability of success. We've increased our chances dramatically. You know, I had a buddy that used to write code for algos, and he basically said that if he could get at, I think it was like 53% probability of being right, he was profitable, period. So anytime you can beat those probabilities, look at Vegas. Vegas has nothing offered to you that is less than a 50-50 probability, or the probabilities are weighted in your favor. The best probabilities in Vegas are on the coin toss of a football game, and that's 50-50. They can't fudge that. other than the juice causes those probabilities to jack a little bit. When you talk about your risk reward and stuff like that, they don't talk about that. Everything else is weighted in their favor, and they've been able to buy quite a few lots and lights in Vegas, right? So if you can get the probabilities in your favor, excuse me, you are going to be successful. All right. The midline is the current price. To the right or to the left is the difference. Absolutely. Yeah. So 0 is where the underline is currently. And then to this side, this would be like a 36 delta. This is like a 10 delta. And basically, I think this is going to be like a 3 delta and then basically a 1 delta kind of. So this is the 16 delta. That's not a very good 16 delta. This might actually be a 5 delta then, something like that. Does that make sense? Do you have a preference for selling spreads on indices such as IWM or SPY? Alan, my preference is really to sell naked strategies. But if I am looking at like IWM, I have short calls on in IWM right now, just naked short calls that I talked about in my daily market commentary. So it was a portfolio adjustment. I felt like my portfolio was getting a little long after we kind of bottomed out here this last time and started rallying. I thought my portfolio was a little too long for the market move up and started adding some short deltas to it. And I used IWM just because I wanted a delta adjustment and it had high implied volatility. All right. And I talk about how to like do this stuff in your portfolio in my market commentaries too, you guys, if you ever want to watch those. And I suggest you do because it's like literally going over a whole new, I go over these strategies in detail in those webinars, why I got into them, go through the steps and all that stuff too. All right, skew. We have to worry about skew because we don't always have a market that has these perfectly symmetrical bell curves. What we do is we have these skews a lot of time. And a lot of times it's actually a negative skew because people have a tendency to buy puts for protection on their stock and it skews the puts to the negative side. And what this is basically the puts equal distance from where the underlying is trading, this being 0 right here and this being 0 right here. You know, these calls, right, you know, their one standard deviation calls are not equal distance from the one standard deviation puts. Same here, the one standard deviation is further out than the other side, right? Okay, so that is skew. And what it is that it's negative skew when people are buying more puts or are bearish or worried about the downside. Positive skews when they're buying more calls. And you can easily figure this out. It's pretty simple. Are you saying that a 33% width of the strike is around a 36 delta? I'm saying when you start out with that 36 delta, when you go out and buy your next strike, whether it's $1 strike, $5 or $10 from that 36 delta, you should be able to collect at least 33% the width of the spread. If you don't, there's other strategies out there that are more appropriate for this underlying. If you've gotten all the way to that point and you basically look at it and you're like, I'm only getting 25% the width of the spread, that would be like a yellow light. If I was only getting 25% the width of the spread, that's like a yellow light. So 33% to say 28% is a green light, 28 to 25% is a yellow light. Any less than 25% is a red light, okay? So you need to at least collect 25%. If all of the other things turn out to be green lights, like the environment, the underlying, the duration, and the strike comes up and you're like, geez, I only get 26% the width of the spread. Well, that's a yellow light. If you're really bullish, then go with it. If you're just kind of like, I don't know if it's really bullish, then I would say maybe move along and find something else. Does that answer your question, John, on the 33% the width of the spread? All right. So let's look at CMG. We're trading right at, and this is obviously yesterday, because it has high implied volatility. I knew it had, well, it's actually because it just had skew. To be quite honest, it had nothing to do with volatility. All right, so look at this. We're looking at 532, and can we say that's close enough to a half to make it good for government work? So 532 and a half lands right in between the 30 and the 35, right? It's actually slightly closer to the 30s, but we can look at the pricing real quick and see middle of the road here is about $27.25, right? 27.25 is about middle of the road for the puts. We go over to the calls. What's the middle of the road? Well, it's about 28.25. So it's $1 higher, and it's actually trading closer to this one by a few pennies. This is skew, equal distance away. We can even look at the 525s and say that middle of the road there is $25, and then go to the the 40s, and you go to the 40s, and you can see that middle of the road is closer to 25.75-ish or something, right? So you can see their skew. These premiums, equal distance from the underlying, is higher. This is call skew or positive skew. When you're looking at something that's relatively neutral, we can look at this and say it's 145. Can we say that it's 145 and this is the at the money? And we go equal distance, so the 140s, it's trading around 723, equal distance to the 50s, 720 something or other. So that's pretty equal. That's going to be kind of like this bell curve, right? It's pretty equal distance from the underlying. And then we could go over and look at put skew. So we look at the look at the strikes. We're trading at 210. Let's say 210s are the ones that are at the money, and we go one tick below or one strike below, we're trading around 280. One strike above, we're trading around 260. And it's actually closer to this strike, right, by 64 cents. So definitely skew to the put side, negative skew. Now, you're like, why are you telling me all this? Well, one thing, as a contrarian, the market tries to hurt as many people as it can, as often as it can. Something like that. I don't remember exactly how that thing goes. But what happens here is people start getting fearful of the downside. Well, if it's going to try and hurt the most people, the most amount of time, and people are more fearful of the downside, it means it's probably going to go to the upside. That's the contrarian in me. It also, I would probably rather sell a put spread here on the one where it's skewed to the downside because I'm able to get further away, right? If I'm able to get further away and I believe volatility is overstated because of fear, then why wouldn't I want to sell these, right? Rather than go with the flow, but that's the way I trade. I'm pretty much a contrarian. So, if you don't like to be a contrarian and catch knives, then maybe that's not the way you go. All right. So, in knowing your exit strategy before entering the trade, with this, I am usually looking to take about 50% of my max profit. Now, when we're looking at a dollar wide spread, you guys, you're going to have to squeeze it out a little bit more than just for 15 cents because after the commissions and everything else, it's not going to amount to much. So if it's only 33 cents, then you're probably going to have to squeeze it out for more, maybe 75% the width of the spread. Get out for a dime, okay, on a 33-cent credit. Get out for a dime. But on anything else, I would go for the 50% of max profit. So on, if you collected $1.70 or $1.65, then you're looking to get out at 80 cents. All right. All right. So if the option change shows a put skew, then it means there is a bearish bias and vice versa. Yes, that is true. That is true. And I am more likely to look at that bearish bias and probably sell a put spread. That's me. When there's people like begging for, premium, like buying premium, I'm the guy that's kind of, hey, you know what? Volatility, I believe, is at its highest. We can look at volatility on a scale. When I talk about implied volatility percent, I'm talking about this chart down here. But when implied volatility percent is up at these levels, why wouldn't I sell it? Where does it go? Straight down from here. So this is where I like to sell premium to those guys that are freaking out because they have to buy it. Sure, I'll sell it to you. Same for down here. If people want to sell me premium, sell me options down here where I'm buying it for cheap. Well, where does volatility go when it's this low? Usually higher, because volatility has a tendency to revert back to the mean. It's comfortable right here in the middle. Gets to extremes, just like stocks. It gets to extremes and it's like, it's too much. All right. So that's what we're looking for. We're looking for it to get to somewhat of an extreme and then get out. That's why in the environment, I said we need a high implied volatility percent environment. And that is above an IV percent of 50. So in order to sell this strategy, part of that environment is we need high implied volatility percent above 50, which is why in that example, I showed you an example of Twilio and an example of FXE, implied volatility percent, completely opposite ranges of the spectrum there. Now, how do you know if it's above an IV percent of 50? Well, one, you can kind of ballpark it. It's not the best way to do it. Another way is you take this fraction, and in the numerator, we have a sum. In the denominator, we're going to take that sum and divide them by each other. So in the numerator, which is on top of the fraction, we take where the current implied volatility is, 37, let's just round it up to 37, and subtract 37 from the low, which is 23. So we have, or 14. So we have 13 in the numerator, right? So 13 in the numerator, and divide that by the high of 51 minus the low of 24. So we have 27. So 13 divided by 27 gives you around a 48%, right? Closer, something like that. So it's very close to what that is. And if I did it all the way out to the decimal, you would see that as well. Another place you can find this implied volatility percent is right down here on TD Ameritrade. So if you don't have it in, most of you won't have it in your watch list. I have the code that goes in there that you can build it out yourself. You have to reach out to us to get, but otherwise you can look right there. I use this really as my scanner. I don't even go to the scan anymore. I basically put all the stocks that I like to trade over here. There's over 50 of them or so, and then put the implied volatility percent, and then I look and just scan right here. I don't even look at what the stock is. I'm looking at the implied volatility percent is. And then when I say, okay, I want to sell premium, where can I sell premium? And then I go and look at it and find my directional assumption kind of thing. Does the TOS tech support have the script for the implied vol? I have this script. If you guys want to reach out to us, you can. Their options have gotten really wide recently. So, I used to trade this a little bit, but I think the Biogen stocks or options have gotten really wide recently. So I wouldn't be trading this one. It's just way too wide. I would say 30 cents wide is what I would trade it at. And even during the day, I think these are almost $1 wide these days. Okay. All right. So we know our exit strategy. 50% the width is what, or 33% the width is what we're collecting. We want to get out at 50% of profit. All right. Max profit. Unless it's like, you're only collecting 33 cents, then I would say you're probably going to have to at least go to 75% or something like that because of the commissions and everything else. The brokerage houses are kind of like lawyers. The only people that win are on a consistent basis are the lawyers because they still get paid. TD Ameritrade, up, down, sideways, they still get paid. They don't care. All right, max profit is the short put minus the long put debit. All right, that's your max profit. It's basically the short put minus the long put. That width, whatever credits left is what you get to keep. All right, the max loss is the difference between the strike prices minus that credit received. We talked about a third the width of the strike. Dollar wide, we collect 33 cents. That's our max profit. Our max loss is the 66 cents or 67 cents or something. All right. And then our break even is the short put minus that credit received. All right. So if we sold the 95 put and we collected $1.50 something, $1.50, let's just say $1.60, then my break even is going to be when it is trading at 93 $1.40, right? And then you add in the $1.60 in there. So our break even, subtract that $1.60 credit from the 95 put, and we have 93.40 is where our break even is. Does that make sense? All right, so this is the part of the webinar where I throw it out. John, I think had one, and yeah, it scrolled off. I can't remember what it was. So if you could throw it back in there. It's PC something, I thought. JQ beat you to it, MU. All right, Micron Technology. All right, so Micron, it's below a 50 IB percent. Now, remember when I was talking about red light, green lights, all that stuff, right? This is below an IB percent of 50. If it is that close, I would just say it is a yellow light. And I would not go really below anything outside of the 40 handle, and I probably wouldn't go anything below the 45 handle. But just suffice it to say, we would be talking about this being a yellow light. Now, Micron had a major spike right back here, which, sometimes we'll have stocks that have a really major spike that's uncharacteristic. Maybe they had a drug trial or something like that. Not that Micron is in that camp, but I'm just saying if they had a drug trial, that you could see a major spike there even outside of normal activity. So you could discount that, right? I have a buddy that will discount that. I will discount it every once in a while because, say, for instance, a drug trial may not come about for another 4 years or so. But we want high implied volatility of above 50 in order for that to come out. To me, this Micron almost looks like volatility is increasing right now and it's below 50. I might stay away from that. But for just for the example, let's go over here and look at it. So we want to find our delta, right? Delta, gamma, and all that stuff. Now, when I said a 36 delta, that's the ballpark to start at, right? You're not always going to find a 36 delta, right? And it's not always going to work with that 36 delta, but that's where we start. So I want to sell this one and buy the next one, right? And I need to collect at least 33 cents because it's $1 wide. That works. Now, you can also go and say, all right, I want to sell this one, but I want to collect more money. So I'm going to go $3 wide, right? $3 wide. So did I do that right? Sell the 36 delta and go 1, 2, 3. That's so that's $4 wide, right? Wait, 5, 6, 7, 8. $3 wide. So we would need to collect about 95 cents. So that's a little bit low for me, So then you can play around. Well, I want to collect a little bit more credit. So let's see if I can at least get 60 cents here. That's pretty close, right? To a third the width. We're $2 wide, 60 cents. So you can do it that way. Play around with it. All right. To get it. If you don't want to stick with the 33 cents on $1 wide, you can stretch it out a little bit more and still get that, same spread width. All right. So you can play around with it. That works. But one thing I want to go through, that yellow light, right? So picking the right environment, that's a yellow light. Picking the right underlying. Under $100 stock, we need 10 cents wide or less. That's a green light. That works. Picking the right duration. We're close to that 35 days. Green light. Picking the right strikes. We got the width of the strikes. Green light. So if you're looking at this and you're really bullish in it, you got a yellow light, but you're willing to take that on, then that I would be fine with. Okay, does that make sense? What's your favorite days to expiration in your spreads? Right here, 35, 40 day. I actually kind of lean a little bit more towards the 40 days because you get in a little bit before everybody starts rolling into your markets and stuff like that. But yeah, right around that 35 days to expiration. Yeah, JQ, earnings. We're not talking about earnings on this. We're going to pretend there's no earnings. Great point to bring up. If you have this strategy and you want to put it on, don't do it like 4 or 5 days before expiration or before that event. For one, markets are going to move. Your probabilities are going to completely change and volatility is probably going to continue to increase. So we don't want to sell premium when volatility is increasing, right? I mean, we can't always avoid it, but we want to avoid it. So we want to pick it in a situation where we don't expect volatility to expand. And we would expect volatility to expand going into a binary event. And for those of you that are not used to the way I talk or whatever, a binary event is just a known event that will affect an underlying. So bonds, what's their binary event? The FOMC meeting, okay? Or an auction. A binary event for stocks is obviously the earnings and stuff like that. So a trial for a drug stock would be a binary event. We know this trial is going to have the results, good or bad, and volatility will jack up in and around that. Any option on very short duration, say 10 days. Alan, usually when I'm trading those, it's for a gamma trade. And I talk about trading those really short gamma trades in a different webinar. But that's usually what I'm trying to do, is take advantage of gamma moving. Use rule to exit a loss on the trade. Jack, good question. The rule for me on a defined risk strategy is I'm going to let it play. I'm going to let the probabilities play out. I know the probabilities are in my favor, so I'm going to let it play out. If this strategy starts going against me, it makes it really hard to get out for, if it starts going against you, it's going to feel like you've taken your full loss already. So I just let it play out. Does that make sense? Slightly confused. Isn't the bull put spread a bullish strategy? Yes. But I thought you said that it is a bearish strategy. No, I want to be clear. This is a bullish strategy. This is a bullish put spread, to be clear. Okay. Somebody else, what was that one with the P something? PMCM or something? Somebody threw something out earlier. I want to make sure. Gene, it was you. It was PMCP. PMCP. Poor man. Oh, you want to do a poor man's covered put. Oh, I have a different webinar on the poor man's covered put. No, this doesn't have the same rules as that. And I do a full webinar on it. Check that one out, though. I was going to say that one I've never really heard of. Yeah, I don't have the exact link, but if you call us, I'll give you the phone number here in a minute. Give us a call and I'll get you set up. Another one here is Nvidia. Let's just take a look at Nvidia. They just had earnings. It was above 50 earlier today. And it looks like it came out a little bit, but it came up today, but it was higher. It was above 50 when I was looking at this, but let's just take a look at it anyway. No earnings. Yes, I think they do have earnings, but I think their earnings actually come in late. We're pretending there's no earnings in this. I have different rules for trading options around earnings, okay? So I'm assuming there's no earnings. Look, there's no earnings. Believe me. No, let's pretend there's no earnings. All right, so we're going to go picking the right environment. IV percent above 50, yellow light, all right? I want a green light, but it's a yellow light. Right underlying. It's a $140 stock. Move it 3 ticks to the left, 15 cents wide. You can see, especially during the day session, this pretty much follows that rule. That's a green light. All right, picking the right duration, 36 days to expiration, green light. Picking the right strikes. Let's take a look. We want to try the 36 delta. We've got the 140s here. It's not a 36 delta. It's a 34 delta, which is fine. It's the closest to that we can find. So let's check it out. So we're selling the 140s, $5 wide, buying that one, 163. So 163 is very close to like 3 times, it's 2 cents off, right? So we've gotten the width of our strikes. $1.65 on a $5 wide. That fits the rule. Green light. If you are bullish Nvidia, all right? So the negative skew is a bearish strategy. Well, the negative skew tells you that predominantly the market is bearish in that underlying. Okay, that's all it's telling you. And the only reason why is because more people are buying puts or buying those puts and are driving the prices up. They're buying those puts aggressively, driving those prices up. Does that make sense? So that creates, it's because they're worried about the downside. So if I'm buying puts, I'm worried about the downside. And if I'm buying them aggressively, I'm really worried about the downside. It doesn't mean that it's going to turn. It just means people are worried about it. So that's how you get that skew. It means more people are buying puts than are buying calls. And if it's an even amount, then they kind of melt. They're basically equal distance away. They're trading around the same price. So we won't be doing the bull put spread in a negative skew environment. I don't want to confuse you guys with the skew too much on giving you a green light or anything like that on this strategy. If you have a bullish assumption, I wouldn't necessarily worry about the skew so much. If you notice you're bullish and you have negative skew, just all I'm trying to tell you with that negative skew is more people are buying those puts and driving those prices higher. So more people are bearish, say for instance, in Nvidia, because we're right in between. The more people are bearish Nvidia right now than they are actually, no, they're more bullish. It's actually pretty even. It's pretty even, right? If we're trading 147.50, that's right in between. We could say that's pretty even on the equal distance away. It's slightly to the puts, maybe. But you could say it's slightly to the puts because of this small amount there, but pretty equal distance. All I'm saying is negative skew means more people are bearish in that underlying. Positive skew means people are more positive in it or more bullish. And to me, because volatility is overstated and people make irrational decisions, buying too many puts when it really doesn't make sense and driving prices higher, then that's the time to go in there and, give them what they want. If you're willing to pay an exorbitant amount of money for insurance, then I'm willing to sell it to you because I think that your fear is overstated and I'm going to take advantage of that. And once people realize, then it comes back in. Okay. Is this similar to the PC ratio? Yes, it is. Like you put call ratio. Yes. Okay. So Nvidia would work on this strategy as well. All right. So third the width of the strike. I would look to get out of this one at about 80 some cents. Right? Would you sell a put in Tesla? I was long puts in Tesla for the longest time. I wouldn't. I'm nervous about Tesla to the downside. I think everybody is coming for Tesla on electric cars. I don't see him. I don't see it making it. I think they have a sexy car and it's probably sexier than everybody else's, but I'm telling you, Audi's coming out with an SUV that's electric. Everybody's coming. And that is going to really eat into their market share. So I would be a little nervous myself. All right. So this is our deal. You guys should absolutely take advantage of this. Floor trader hacks. Some of those things I talked about with the Delta, there's about 5-6 things that Delta tells you. I go over all of that stuff in this webinar. We're giving you both of these. You can see they're $497. We're giving you both of them for $497. So we're talking, probably over maybe 10 hours of content here and probably, 20 hours of content over here. So massive amounts of information that you guys could literally watch for the rest of the year. And you don't have a time limit on it. We actually have it set up. It's a really nice setup right now where you guys can go in there and check it off. Like it's actually a little box that you can check off to say, I've watched this one already. So you can keep track of where you're going. So make sure you guys take advantage of this. It's huge. All right. Taking advantage of all of the different aspects in and around trading options. If you guys, the only way to really become a successful trader is to be confident, right? To not second guess yourself. And the way to not second guess yourself is to know exactly the levers and pulleys of the market. And that's what I try and teach you guys in this. The levers and pulleys, when is the highest probability situation to set these strategies up in. And if you are more confident, you're going to put on more strategies, which ultimately makes those probabilities come to fruition, right? If you only do one stock on one option or one option strategy every single time, then you're kind of beholden to that one underlying holding to the probabilities. If you have several of them spread out, those probabilities will work themselves out. Not what I'm trying to say is if you just do it one time and you get bit, just know going forward that the probabilities are in your favor. All right. It will work itself out. So for $497, this link is in the chat window. Sorry, it's not in the questions box. We've been going back and forth in the questions box. Over there in the chat window, I've added it. You can just click on that. It's a hot link. If you guys are watching this on tape delay, you're going to have to pause this video and punch this into your URL, which is the same one. You'll have to pause it. But I just want to thank you guys all. Later webinars will drill down on different option components, how and where I find those trades appropriate. Also, you can reach out to us at 310-598-6677 or email us at protraderstrategies.com. If you want that poor man's covered call or poor man's covered put, let me know. We'll get you set up with that when you call in. But with this one, you guys, this is a huge amount of content that everybody should know in order to be successful. All right. This is the building blocks of trading options. So you guys should take advantage of that. All right. That's all I got for you guys. I hope you have a great weekend. And if you can't take that, take it easy. Take it easy, JQ. Thanks, Andrew. Appreciate it. Thank you, guys. Thank you for all your kind words. So yeah, take advantage. It's in the chat window. Yeah, not the questions box, chat window. Ted, good to see you, bud. Thanks, Joseph. Appreciate the kind words. Here's that link again.